In our education system, there is a Bachelor of Commerce, Bachelor of Arts, BSc, BBS, etc. But I've never come across a Bachelor of Investing. And that's probably because a lot of investing is based on our opinions and experiences. This video is a compilation of those very learnings which I am presenting in the form of the 10 commandments that I follow. It's something that took me a long time to really figure out, and while you might be knowing many of these or must have read it in some books, I thought a little dash of my own experience might cement our understanding of it. So essentially, if you are a beginner to investing, then use this video as a checklist. And if you have been investing for some time now, then do add a commandment or two of your own via the comments box below. Let's begin. For all of us, there is no single financial goal. Our desires include a house, an expensive vacation, car, child's education, charity, and so on. We need to accomplish a lot, and therefore it is important to list down what one needs, when one needs it, and how are you going to achieve it. For example, before I quit my job and started this YouTube channel, I wanted to have a better clarity towards my retirement needs. It's an important goal, so I put some thought into it and came up with a simple plan that I call the 10-bagger framework. So I am 42 years old, and let's say I have 1 crore with me today, which means at an annual compounding of 12.2% that any diversified equity fund can deliver, that 1 crore would have grown to 10 crores over the next 20 years. Factoring my expenses, inflation, growth in corpus, etc. And per my calculations, this number sufficiently takes care of my retirement needs and became a very strong basis for boxing this goal and keeping it aside. In the same thread, it's also important to have realistic expectations, and I generally follow the inflation plus 6% rule. That is, my portfolio should be designed in such a way that it grows about 6% higher than the rise in my household expenses. So that's the first commandment, and if you haven't done it yet, then do list down your top 5 financial goals and, more importantly, figure out the best way of achieving it. Okay, so 1 becomes 10 in 20 years when it compounds at 12.2%. That's okay for a person like me, but if one wants to get there in half the time, then your money would need to grow at 25.9%, which means together with the rate of return, time becomes our greatest ally in wealth building. I often share this illustration of how a 20-year-old can convert a lakh of rupees into 1,000 crores by the time he or she reaches the age of 70. And it needs just 2 things. A, an investment vehicle that repeatedly grows at 25.9% every year, which is easier said than done. And B, you need patience. In fact, this word patience sounds so simple, but it's actually quite difficult to implement. I mean, we all have our stories, and mine is about a small investment I made in Titan Industries when the entire company had a market capitalization of about 200 crores. Yes, you heard that right, 200 crores. It was a great buy, but I did what many of us would have done and sold my shares in Titan as soon as the price doubled. And over the years, I watched in shock, awe, and disgust as the price doubled and 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 doubled. Titan became a 1,000 bagger in less than 20 years, and to put things in perspective, in 2023, the profits that this company makes in a single month is greater than what the entire company was worth in 2004. I'm certainly a bit wiser now, but remember, impatience is investing's costliest emotion, and I learned it the hard way. A building's foundation is made of steel, bricks, and concrete. Likewise, a portfolio's foundation comprises of 3 things. The first is asset allocation, and a well-defined mix is one that supports your investment goals, consists of diversified, low correlation assets, and is also flexible enough to take advantage of tactical opportunities. The second part of the foundation is rebalancing. It's something I used to ignore, but over time I have understood the importance and the utility of it. To put it in numbers, my own mutual fund portfolio, which consists of domestic equities, international funds, debt, and gold, does about 2% better than a standard balanced fund. But thanks to tactical asset allocation and rebalancing, it does that by taking a lot less risk. And the third layer when constructing a strong foundation is to know what one needs to avoid. For example, and in my case, I tend to avoid sectoral funds, debt funds with low credit quality, NFOs, most IPOs. I also don't invest in beaten down companies or companies which have governance issues, etc. The way I look at it is that a strong foundation for one's portfolio is about getting a few things right. And in my view, it's the asset allocation, the rebalancing, and a clear understanding of what is preferred and what is avoidable. The fourth commandment revolves around risk and return. Now notice I didn't say risk or return, I said risk and return. And that's because a majority of investors, especially in our country, are either too much focused on risk, which means they invest in fixed deposits and LIC policies, or they are too aggressive to the extent that they work with only equities at any point of time. In my experience, smart investing is about playing the odds. Take the P ratio as an example. Now, there are points in time when the P ratio is way above the long-term average of 20. And there are other times when the ratio is on the lower end, which generally flags a period of undervaluation. Which logically means as investors, we should be investing big when the equities are undervalued, and we can ease off a little bit when valuations are super high. In numbers, any investment made when the P ratio is below the 18 mark has resulted in returns of 12% or more, and the odds get reversed when the same investment happens at a PE of 24 or more. It's an understanding of these odds which makes this commandment a very powerful and profitable one. And if you think holistically, it is not limited to just the P ratio. For example, in the video on REITs, I explained how one can tactically use the market price to NAV metric to make an additional 10 to 15% in returns. So different industries have their own pressure points, but the point is, by playing the odds, you not only make big money, but you do that by taking a much lower level of risk, which is what smart investing is all about. A common practice amongst everyday investors is to chase historical performance. That is, we tend to invest in mutual funds which have done well in the past 1 or 2 years. How do I know this? Because until a few years back, I was that guy. But over time, I observed that many of those funds which were ranked in the top quartile found it very difficult to replicate that performance in the subsequent year. I mean, look at this table here. Notice the large number of red squares, which shows those schemes which were amongst the top 25% in 1 year and landed up in the bottom 25% in the subsequent year. It's something that happens time and again, and yet the investors' hunt for the best mutual fund continues at high intensity. On my part, I have adequately moved away from trying to discover the best mutual fund scheme to figuring out the right combination of funds my portfolio deserves. It's an approach I have adopted to stock picking as well, and I now look beyond screeners and spend time examining the business models, the economic moat, the growth runways, regulations, global macros, etc. This is certainly one commandment that you should not ignore. Alright, commandment 6 is to stay away from hot tips. Let me explain this with a small experiment. So I have 1000 phone numbers on my mobile phone, and let's say on day 1, I split those 1000 numbers into 2 halves of 500 each. To the first 500, I send a WhatsApp message that says, the Reliance stock is going up today. And to the other 500, I write, the Reliance stock is going down today. Now, one of these two things is bound to happen. Let's say the Reliance stock goes down. So on day 2, I'll take the list of those 500 people who got it right, and I split them further into 2 groups of 250 each. This time I'll say Infosys will go up today to the first group, and to the other 250 I'll write Infosys will go down today. Again, one of these 2 groups will get the right advice. Now if I continue this sequence for 10 days, there will be one person who would have got 10 correct stock tips in a row. Now you tell me, assuming you have been getting good stock tips on a Telegram channel or over WhatsApp, what's the guarantee that you are not a part of the same process that I explained here? You see, the thing is, while there are certainly some honest, well-intentioned and talented people in this business, but for every good piece of information you receive, there is likely to be a dozen poorly constructed advice by unscrupulous characters which will hurt you financially. So as this commandment implies, the next time you are exposed to some so-called expert information, stay curious, but as the popular hashtag says, do your own research. Never before in the history of mankind has investing been so convenient. I mean, one can invest in stocks, mutual funds, NPS, gold bonds, fixed deposits, and dozens of other instruments at the click of a button. The issue with all this convenience and a touch of marketing is that people tend to perceive everything as easy money. This pushes them to invest in new and largely untested areas like cryptocurrencies, NFTs, meme stocks, SPACs, virtual assets, etc., where while a few of them make a lot of money, it's the majority that comes out on the wrong side of a transaction. The point is, being boring and effective is any day better than approaching wealth building in an exciting but ineffective way. My own approach has been supremely boring and comfortably effective, and in my view, wealth creation via marginal but incremental gains has a better probability of success as compared to sudden, half-baked and risky endeavors. The wisdom around debt takes me back to Rich Dad Poor Dad, where Robert Kiyosaki classifies a debt as good or bad. So bad debt is borrowing money for buying things that lose value over time, while a good debt is when that same money is borrowed to purchase appreciating assets, which then allows you to make more money over time. Now, this might give us an impression that borrowing money for buying mutual funds or stocks is a clever thing to do. But looking at the probabilities, and in my view, the downside of using debt is a lot higher. Case in point is the recent episode involving Bill Huang of Archegos Capital, whose leverage position lost him over $20 billion in a matter of just 10 days. It was a case of unnecessary greed, and in that same thread, one should be careful when investing in futures and options, especially if you don't understand it completely. Truth be told, I check my mutual fund portfolio only once a month. Of course, my behavior towards stocks is a bit more frequent, but from looking at the stock price many times during the day, I now look at it just twice a week. This change in habit has certainly improved my personal and financial well-being, and there is an interesting and emotional way to understand this. So say you start crying whenever you see a loss in your portfolio tracker, which means in the last 20 years, and assuming you check your portfolio every day, you would have wept a total of 2,279 times. This number 2279, it represents the number of trading days when the Nifty ended up at a loss. Now instead, if you had checked the Nifty every week, then one would have cried 442 times in the past 20 years. A once a month check would come to 240 emotional moments. Every 6 months is just 13 unhappy tears. Every year is 7. And if you were to check your portfolio every 5 years, then you would not have shed a tear. It's a very different way of looking at things, because checking your portfolio every day versus checking it maybe once a month will give you the same result, but without the unnecessary emotional baggage that comes with it. In fact, I had shared this very point in a slightly different format in my channel's community page. So if you haven't subscribed to my channel yet, then do give it a try. Alright, the 10th commandment is around learning, and let's face it, information is today more accessible and affordable than ever before. I mean, when I was a student, knowledge was scarce and there was no access to the internet, but now there is an almost unlimited number of websites, social media platforms, YouTube videos, and even education apps that are literally stalking us to consume their content in ever-evolving formats. Of course, too much information has its own problems, which is why I have a small but well-curated list of resources that I follow, and in equal stead, the creation of this channel and the research that goes towards making these videos acts as a wonderful catalyst for continued learning. So promise yourself to be a lifelong learner and build that ability of connecting one concept with another. In fact, I said this very recently in a webinar that there is no single approach that I follow like coffee can or magic formula or can slim, etc. But instead, I prefer to pick the best parts of different concepts, and I create 2 to 3 different portfolios, which allows me to tweak and improve my own understanding of investing. So these were the 10 commandments that the God of investing has bestowed upon us, and as his messenger, I am passing it to you. I wish you well in your investing journey, and I thank you for your time, your subscription to my channel, the shares, the likes, and I'll see you 3 days from now. Until then.